Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall alongside Kevin Hinks over at the SIBO. Time now for our cash tag segment. For that, we want to bring in our next guest, and that is Landon Swan, co-founder of LikeFolio, taking a look at Mickey D's and if maybe there will be some gold in coming back to those arches there. So, Landon, I'm curious to know, when you look across the landscape, the consumer landscape now, how does McDonald's fare? Because, you know, the shares have underperformed the broader market so far this year. But what are you seeing?
Yeah, they have. And, you know, I mean, when you think about, you know, everything we talked about it yesterday, the K-shaped economy, the haves and the have-nots. You know, normally you want the, you know, rising tide lifts all ships. You want the fastest ship. This is the opposite. So you want the best fast food restaurant of all the ones that are kind of struggling. And fast food is struggling because consumers that are, you know, not doing great right now are looking to save money. You have to compete on price. And it's a race to the bottom, and that's kind of where fast food is right now. If you look at, you know, Wendy's stock, they're at the bottom of our list, and that stock has just been decimated. McDonald's, though, is actually at the top of our list, so they're the winners among this very tough peer group, very, very difficult situation. So McDonald's doing really well amongst you know, a very tough economy. And you can see some of the ones that are struggling. I mentioned Wendy's, they're doing poorly. And then a lot of the other ones down there. Popeye's the only one kind of hanging in with McDonald's. But McDonald's is actually doing it. They're, you know, just like I said, you compete on price. That's what they're competing on. So they brought back the value meal. They've got the $5 meal deal. They've got the buy one and add one for $1, the $2.99 snack wraps. I mean, they're going all in on value, and they got away from that for a while. And that's what actually really hurt them. Is I think all the fast food companies kind of got away from that. Costs were rising, both labor and you know, input costs were rising, and so they raised prices. And then people said, you know what? Instead of fast food, I'll just go to a fast casual, and then those got expensive. They said, all right, well, let's go to a sit-down restaurant. So now they're coming back. The prices are lower. McDonald's is competing on price. They also did a really good job with the crispy chicken strips and the Minecraft tie-in meal. That brought the family and the younger crowd back who had been cutting visits. So they saw a deficiency in what they were doing. They were losing on price. They were losing the family and the younger members. And they're still somewhat struggling with the lower income crowd, but they're doing better than all of their competition. So this is a tough economy right now for fast food, but you know, leave it to the best of the best to navigate it. And they're number one right now among those. This is, you know, if I'm a long-term investor, I don't think I want to own any of the fast food companies, but if I had to pick one, it would be McDonald's at this point.
Landon, this is one of those segments where the LikeFolio data is jumping off the page at us. It shows that McDonald's is the clear winner. It shows that McDonald's is getting stronger while the stock is underperforming. There's divergence on your second graph. But Landon, let's stretch our brains even more. If no one thinks about AI and McDonald's, but you know what AI needs? Data. And you know what? If you're making choices on the cost of food, which food to produce, how quickly, or you know, the time to do it, you need data. How about choosing locations for a new store? You know what you need? Data. And McDonald's has massive amounts of data so they're perfectly set up for AI to help them make their business more efficient. So despite your data that is clearly strong and clearly showing divergence in the stock price and the interest, it's also an AI story for McDonald's, isn't it?
I think it's got some upside there. I think that's a great point. I mean, they do have a ton of information, obviously. You know, they sell the most, and I think about half of their users use the app and the rewards program, so they can track it down to the user level. But even if you don't, you know, look at that, you can consolidate it at the location level or just in general, like all kinds of, you can slice and dice data a million different ways. But yeah, here's what you're talking about. Our data in the blue line, the stock chart in the dashed line. The stock has been basically sideways. I mean, they pay a dividend, but it's been basically sideways. and it's pulled back a little bit with everything, and the data just continues to improve. So people are definitely getting more and more interested. We do know that sentiment is up significantly. It dipped quite a bit when their prices were up. Now they're back down. Sentiment is up significantly. What we don't know is how much this is going to affect margins. We don't have insights onto that. So we know that, their transactions are up, and the check sizes are down, but we don't know exactly what their margins are looking like. Surely they're getting squeezed a little bit by competing on price. But you're right. Yeah, they have done a good job in the past of using technology to their advantage. So I don't have any doubts that, with the vast amount of data that they have, they could make a play for, adding better locations, making smarter menu choices, doing better promotion, things like that. So they finally, last quarter, they finally snapped a sort of a soft same-store sales number. They got it up to 2.5%, where it had been pretty weak before. International's growing. They just bumped up their dividend by 5%. So overall, they're moving in the right direction. It's just they're swimming upstream. I mean, that's the problem right now is McDonald's is swimming upstream. But of all of the fast food restaurants, again, you can see it on this chart here, they have a big divergence number. So, we are bullish heading into this earnings report, partially because the stock is so beat up and it just hasn't done anything over the last little while. Compare that to Wendy's, which is just basically straight down. We're not bullish on that one, even though the stock has been extremely sold. They're performing very poorly. So McDonald's is winning the space in a tough market, and I don't think that the investor side really understand that they're the leaders here. I mean, obviously they're the leaders, but as far as overperformance, so they're beating up the competition really well, doing a good job, surviving, swimming upstream, and they're swimming fast. It's a tough battle, but I think that they've kind of been thrown out with all the fast food companies where maybe they don't deserve to be thrown out, because I think that they're overperforming, at least according to our data.
Landon, let me ask you this. I know this is according to your data, but we got earnings from Yum Brands today, and they did better than expected. There was strength in Taco Bell, in KFC, two of those on your list. So you see some growth in your chart on KFC, although, Taco Bell seems to be lagging. But if you look at the price point, because I just did a quick AI comparison of pricing of McDonald's versus Taco Bell. So that's just obviously one of their brands. And the price over at Taco Bell beats McDonald's. So if you're, in the K-shaped, whichever part of the K-shaped economy you're in, if you're making a decision on price, maybe Yum Brands, there's a point that it could potentially be eating McDonald's lunch. And those shares have outperformed McDonald's, not by much, but before today, they were up 4%, adding to that with a big move today. So is it possible that there's some strength that, we might be missing here as it relates to Yum Brands compared to McDonald's?
Yeah, I think you could read it that way. I think you could also read it that the consumer consumers flocking to value, right? And I think that's the kind of the way we've seen it, is that for so long, fast food was the value play automatically by default. And then over the last, from 2021 to maybe 2023 or 4, it got really expensive. And we saw all kinds of things on social media where people were posting their value meals that they got that were super expensive. The family of 4 is going for $60 and things like that. And it's just like, why are we not going to Olive Garden instead, right? If we're spending $60 at McDonald's, it doesn't make sense. And so I think that was a huge shift away from fast food over the last 12 months or so. And just now, I think we're starting to see some of these companies come back and compete based on value. And so the way I would read that is Taco Bell's doing a good job of value and they won. And I think that McDonald's is doing a great job of value, and I think they're going to win on this earnings report. Now, again, long term, I don't love any of these companies because of the K-shaped economy. I don't want to swim upstream, but if I've got to pick one, and this is the case for tomorrow's earnings report, I'm going with McDonald's. I think they've got a good earnings report coming up. I don't think it's going to be super strong, but I think that they're going to beat expectations. Yum may have tipped their hand a little bit if people are thinking the way we do, where value is coming back and that's going to win. So we'll see about that. But overall, I think the stock's been beaten up pretty well, and I think it's undervalued at this point. So it's worth an earnings play, in my opinion. Long term, maybe not so much, but definitely an earnings play.
So a value for the value menu, potentially, if the value menu really ever comes back at McDonald's, because it does feel expensive the few times I've gone there. Thank you, Landon. That is Landon Swan, co-founder of LikeFolio.